Blockchain technology, often linked to cryptocurrencies like Bitcoin, extends far beyond just digital currencies. Its core qualities of transparency, security, and efficiency position it as a transformative force in the financial sector. Blockchain can streamline financial operations, reduce costs, and increase trust, making it a game-changer across various financial processes. In this video, we will explore how blockchain is reshaping finance and why it's poised to become an essential tool in modern financial systems. Blockchain in payment processing. One of the most immediate and practical applications of blockchain is in payment processing. Cross-border transactions, in particular, can be time-consuming and costly due to the involvement of multiple intermediaries. With blockchain, these payments can be processed quickly, often within minutes or even seconds. Blockchain eliminates the need for central clearing authorities, reducing the risk of errors, fraud, and high transaction fees. The decentralized nature of blockchain ensures that payments are secure and transparent, providing faster, cheaper, and more reliable cross-border transactions. Blockchain in supply chain finance. Blockchain also has significant potential in supply chain finance. By providing a transparent, immutable ledger of transactions, it ensures that every step of a product's journey from producer to consumer is visible and traceable. In industries like pharmaceuticals and luxury goods, where authenticity and provenance are crucial, blockchain's ability to tag products with tamper-proof digital identifiers adds a layer of security. Blockchain in trade finance. Blockchain can automate and digitize these processes, making trade finance transactions faster and more secure. For instance, smart contracts can automatically trigger payments once conditions are met, such as confirming the receipt of goods. This reduces the need for intermediaries, speeds up the process, and cuts down on costs, making global trade smoother and more efficient. Blockchain and regulatory compliance. With its immutable ledger, blockchain can store data in a way that regulators can access it in real time, providing an auditable trail of all economic activities. This transparency makes it easier to comply with regulations like Know Your Customer, KYC, and Anti-Money Laundering, AML, reducing the risk of compliance violations and fines. Blockchain's timestamping and immutable nature also make it ideal for audit processes, offering a tamper-proof record of every transaction. Tokenization of assets. Blockchain is not just for cryptocurrencies. It enables the tokenization of real-world assets, such as real estate, stocks, or even artwork. Tokenization involves converting ownership rights into blockchain-based digital tokens. By breaking down these barriers, tokenization makes assets more liquid, enabling them to be traded more easily on blockchain-based platforms. This can lead to increased market efficiency and the opening of new markets. Smart contracts, a new era in agreement execution. Smart contracts are self-executing contracts where the terms are written directly into code and automatically enforced by the blockchain network. This eliminates the need for intermediaries like lawyers or courts, reducing costs and speeding up contract execution. The key feature of smart contracts is trustlessness. In other words, parties do not need to trust each other because the contract is enforced by the technology itself, ensuring that the terms are automatically carried out once conditions are met. Efficiency and cost reduction through smart contracts. Smart contracts significantly enhance efficiency by automating processes that would traditionally require manual intervention. For example, in the insurance industry, a smart contract could automatically release payments when specific conditions, such as flight cancellations or natural disasters, are confirmed. This automation not only speeds up transactions, but also reduces administrative overheads and associated costs. In industries like real estate or finance, where breaches of contract can have serious financial consequences, smart contracts provide a higher level of security, reducing the risks of fraud and human error. Opportunities in various sectors with smart contracts. The implications of smart contracts extend far beyond finance. In supply chain management, smart contracts ensure that all parties meet their obligations on time. For example, when a supplier delivers goods, a smart contract can automatically notify the buyer and release payment, all without human intervention. In the entertainment industry, smart contracts could automatically distribute royalties to creators every time a song is played, ensuring fair and timely compensation for artists and contributors. Legal and regulatory challenges for smart contracts. In many jurisdictions, the legal standing of contracts written in code is still unclear, raising questions about enforcement and dispute resolution. Furthermore, while smart contracts are designed to execute automatically, they are only as reliable as the code they're written in. Faulty code or unforeseen circumstances can lead to errors, making it crucial for developers to understand both legal principles and technical coding. Tokenization, unlocking new investment opportunities. Tokenization is another area where blockchain is making a significant impact. It involves converting physical and digital assets into blockchain-based tokens that represent ownership rights. This allows assets like real estate, fine art, and stocks to be fractionalized, making it easier for individuals to invest in them. Tokenization lowers the barriers to entry for investors and opens up new markets by enabling easier trading and liquidity. Security and liquidity with tokenization. Tokenization also enhances transaction security and liquidity. Since blockchain transactions are recorded on a decentralized ledger, they are transparent and immutable, reducing the potential for fraud. Moreover, tokenized assets can be traded more easily and quickly compared to traditional assets, which often involve lengthy and costly processes. This allows investors to buy, sell, and trade assets more efficiently. Challenges of tokenization. However, tokenization also faces challenges, particularly around regulation. The legal framework for tokenized assets is still developing, and regulators are working to catch up with the rapid pace of innovation. Issues like classifying tokens, whether they're securities or commodities, and ensuring compliance with existing financial regulations must be addressed before tokenization can reach its full potential. Decentralized finance, DeFi, innovations. DeFi represents a shift away from traditional centralized financial systems, embracing a peer-to-peer model built on blockchain technology. At its core are smart contracts, self-executing contracts with terms coded directly into them. These ensure security, transparency, and the elimination of middlemen like banks, giving individuals greater control over their finances. One of DeFi's standout innovations is lending and borrowing. Platforms like Compound and Aave allow users to lend and borrow directly from each other via smart contracts. There are no intermediaries, and interest rates are dynamically adjusted based on supply and demand, creating a user-controlled ecosystem. Another game changer is the rise of stablecoins. Unlike other cryptocurrencies, stablecoins are pegged to stable assets like the US dollar or gold, minimizing volatility. This makes them ideal for daily transactions and bridges the gap between traditional currencies and crypto. DeFi has also revolutionized trading with decentralized exchanges, DEXs. Unlike traditional exchanges, DEXs such as Uniswap and SushiSwap allow users to trade assets directly from their wallets. With no central authority, these exchanges reduce the risk of hacks, fraud, and high transaction fees, offering greater security and lower costs. Then there's yield farming, where users lock up their cryptocurrency in smart contracts to earn rewards. While this has opened new earning opportunities, it also highlights the growing complexity of the DeFi ecosystem. However, DeFi isn't without challenges. One of the biggest hurdles is regulatory uncertainty. Operating outside traditional systems makes it hard for regulators to enforce protections, curb illegal activities, or ensure consumer safety. Additionally, the usability of DeFi platforms poses a barrier. For newcomers, navigating intricate interfaces and understanding blockchain concepts can be intimidating. Broader adoption requires simplifying user experiences and providing accessible education. Looking ahead, collaborations between traditional institutions and DeFi platforms could create hybrid models, combining the stability of centralized systems with the innovation of decentralization. Blockchain for transparency and audit trails. Next, let's explore how blockchain is transforming transparency and audit trails across industries. While blockchain is often associated with cryptocurrencies, its applications extend far beyond finance. At its heart, blockchain is a distributed ledger, recording transactions across a network of computers. These records are immutable. Once entered, they cannot be altered or deleted, ensuring unparalleled trust and security. In finance, blockchain offers a way to replace opaque processes with transparent systems. Traditional financial systems often involve intermediaries that can introduce errors or fraud. For auditors, blockchain provides a permanent, tamper-proof record of activities, streamlining compliance processes and ensuring regulatory standards are met with greater efficiency. Beyond finance, blockchain has significant potential in supply chain management. By providing end-to-end visibility, it ensures the authenticity of goods. For instance, pharmaceutical companies can track medicines from production to sale, reducing the risk of counterfeit drugs. Similarly, the food industry can verify the origin of products, assuring consumers of ethical sourcing. In the public sector, blockchain can enhance government transparency. By recording transactions on a public ledger, citizens can access real-time data on expenditures and allocations, reducing corruption and building trust. Blockchain is also revolutionizing voting systems. It makes votes tamper-proof, ensuring every ballot is counted while enhancing the transparency of the election process. Challenges in blockchain adoption. Now, let's address the broader challenges of blockchain adoption. One of the primary technical issues is scalability. Blockchain networks like Bitcoin and Ethereum process far fewer transactions than traditional systems like Visa. Because every node must validate each transaction, the system is inherently slower. Emerging solutions like Layer 2 scaling and sharding aim to tackle this issue, but these technologies are still in development. Another major concern is energy consumption. Blockchain networks using proof-of-work algorithms like Bitcoin require immense computational power, resulting in significant energy use. To address this, many projects are exploring energy-efficient alternatives, such as proof-of-stake consensus mechanisms. On the regulatory side, blockchain's decentralized and anonymous nature complicates oversight. Traditional financial systems are tightly regulated to ensure compliance. But blockchain challenges these frameworks, particularly in sectors like banking and healthcare. Crafting laws that balance innovation with security remains a pressing task. Finally, public perception remains a hurdle. While blockchain offers much more than cryptocurrency, it is still closely associated with crypto's volatility, fraud, and hacks. Shifting public understanding toward blockchain's broader applications is essential for its mainstream adoption. Conclusion. While challenges remain, such as scalability, regulatory uncertainty, and energy consumption, these technologies are on the path to reshaping how we interact with money, assets, and information. As these hurdles are overcome, blockchain and DeFi will become integral components of a more inclusive, secure, and transparent financial system.